This is the beginning of part 2 of our module on commodities and commodity derivatives, which examines the role of commodities as an asset class for end users, investors, and traders, analyzes the key differences between commodities and other typical investments, such as stocks and bonds, and illustrates some of the classical uses of commodity derivatives in the fundraising, hedging, and investment processes. We remind you that this part 2 contains chapters 3 to 5 of the module, with chapter 3 focusing on how corporates incorporate the use of commodity derivatives in the fundraising process to reduce their cost or obtain a number of accounting benefits. Chapter 4, examining a number of typical structured notes that embed views on commodity prices. And Chapter 5, containing the quiz. This Chapter 3 continues the review of derivative use by end users, focusing especially on how corporates incorporate the use of commodity derivatives in the fundraising process to reduce their cost or obtain a number of accounting benefits. We focus on 3 applications. First, the incorporation of short option positions on commodities to which the borrower has a natural exposure to reduce the headline coupon of the fundraising. Second, the use of a commodity forward to hedge the price risk of inventory in what is called an inventory monetization. And third, the sale of future production or production revenues from commodities to generate upfront funding and the related use of forwards, swaps, or options to reduce the price risk of the underlying commodity and achieve better funding ratios and pricing terms. Numerous other applications exist, but these 3 will give you an excellent flavor of the more common transactions. Beginning with the use of options in a fundraising transaction, assume Exxon can borrow in the bond market for a 5-year tenor at 5% with coupons paid semi-annually, but wishes to lower its cost by giving the bondholder additional interest if oil prices exceed a certain level on coupon payment dates, in exchange for lower interest when crude prices fall. Specifically, the coupon starts at some specified minimum level and increases by 1% annualized for each $5 increase in the spot price above the current 100. Increases that are not exact multiples of $5 result in proportional coupon increases. The logic of this arrangement, as you may have intuited, is that high oil prices increase Exxon's revenues and strengthen the company's financial condition, making the additional coupons more affordable in exchange for reduced coupons when prices are low. We assume oil is trading at 100 per barrel in the spot market, that the risk-free interest rate is 4% for all maturities, that oil price volatility is 20% annualized, and that the convenience yield is 0 to keep matters simple. Finally, we assume Exxon wishes to raise $100 million. You can probably recognize the similarity between this construction and the convertible bond. A convertible bond lowers the borrower's obligation for coupon to a stipulated minimum in return for granting the holder participation in future upside in the borrower's stock price. The difference here is that the holder participates in future upside not in the borrower's stock price, but in the price of its principal revenue driver, namely crude oil. Convertibles being essentially combinations of bonds plus call options on the borrower's shares, the present instrument appears to represent a combination of a bond plus call options on crude. More specifically, in the structure we have described above, Exxon appears to have sold 10 series of European calls on crude, each expiring on a coupon payment date, with the additional coupon under the bond representing the payoff, if any, of these calls when they expire in the money. The aggregate premium Exxon earns from selling the calls is calculated up front and then spread over the life of the bond in the form of the reduced coupons. Worksheet Crude Options permits us to price European calls on crude using a model identical to that for pricing equity or currency options. A model of this kind assumes geometric Brownian movements in the spot price, something we argue does not apply in the case of crude oil and most commodities over the long term. We use it here because it is simple and probably familiar to you already, and because many practitioners adapt it for commodities by simply adjusting the volatility input to take account of mean reversion, rather than relying on more complex models that reflect mean reversion more specifically. We have listed in cells C7 to C12 the market conditions mentioned a minute ago, except for cell C8, which simply converts the 4% semi-annual risk-free rate from cell C7 into 3.88% on a continuously compounded basis, a necessary first step to the use of this option pricing model. Note carefully that we have first had to translate the 4% into its effective equivalent via the nominal operator in Excel before applying the natural logarithm function to reach continuous compounding. These concepts are all discussed in detail in our module Bond Fundamentals. The premiums for calls with different maturities appear in column H, and the sum of the premia for all 10 call options is revealed in the cell H17 to be $165.30. This is a premium Exxon could claim up front, but as we mentioned previously, it receives it instead in the form of reduced coupons. We therefore need to annuitize this upfront premium into a series of 10 equal semi-annual payments, and also to figure out the precise number of underlying barrels on which Exxon will sell these calls. Worksheet annuitization assists us with the first task. We set in cell C19 a guess of $15 for each cash flow in the annuity. Then we show in column C the discount factors for each semi-annual period. Using a 2% discount rate for each of these periods, and then we calculate in column D the PV of each semi-annual cash flow from the annuity simply by multiplying the cash flow by the related discount factor from column C. We then sum these PVs together in cell D16 and reach a total of 134.74, which is quite a bit lower than the upfront 165.30 that we are seeking. We now use goal seek to find the exact size of each cash flow in the annuity. Thus, tools, goal seek, set cell D16 to value 165.3 by changing cell C19, hit OK, revealing a result of $18.4 or $36.8 on an annualized basis in cell C20. This $36.80 is what Exxon receives annually in exchange for granting to the bondholder 10 call options, each on 1 barrel of crude oil, each struck at $100, and each expiring on a successive coupon payment date under the bond. We still need to determine the precise number of underlying barrels for each call option, which will be a function of the upside participation formula stated initially, and in turn will determine the annualized cost savings for Exxon. If, for example, we make the number of underlying barrels equal to 10,000, the annual savings would come to 10,000 times 36.8 equals $368,000, which, relative to a $100 million bond principal, would represent annualized savings of 36.8 basis points. In turn, this means that if oil reaches 101, i.e. $1 above the $100 strike of each call option, the bondholders in aggregate become entitled to an additional cash flow from exercising the call options equal to $10,000, which is equal to 1 basis point semi-annually relative to 100 million, or 2 basis points annualized. But we are targeting a 20 basis point increase in the investor's coupon per dollar of price increase above 100. So we need to multiply the number of underlying barrels by 10, reaching a figure of 100,000 barrels. In turn, this increases the annualized premium earned by Exxon from 36.8 basis points to 3.68%. This is used to reduce the coupon otherwise payable on a regular 5-year bond from 5% paid semi-annually to 1.32%. We are ready to write the term sheet for this transaction. Here's the term sheet, and here is the formula for the coupon. The max operator in the coupon formula represents the payoff of the call option expiring on the coupon payment date, and the need to divide this expression by 500 stems from the need to convert a payoff of 1 to 0.002 in percentage terms, which is equivalent to 20 basis points, of course. Thus, each dollar above 100 that the spot price of crude reaches translates into 20 additional basis points of annualized coupon for the bondholder, so every $5 become an additional 1%, exactly as intended. We test the formula to see if all works as expected. Suppose the price of crude on 2 coupon payments in one particular year happens to reach $115 per barrel. The investors receive on each payment date a gain from the expiring calls equal to 15 times 100,000, the latter figure being the number of barrels underlying each expiring option. This represents a total of $1.5 million semi-annually, or 3% annualized, relative to a principal amount of $100 million. This is exactly in accordance with Exxon's promise to pay an additional 1% in coupon for every $5 increase in crude above 100. The trade-off for the bondholder is clear. The risk of ending with a coupon of 1.32% only is offset by the possibility of reaching far higher returns if oil surges in the future. If, for example, oil returns to its all-time high of $147 per barrel and stays there for 2 coupon payment dates in succession, the return to the investor for that year would equal 132 plus 47 over 500, which comes to 10.72%, or more than twice the 5% Exxon would have paid on straight debt of that maturity. But our focus here is on the borrower. So we spend a minute analyzing the position Exxon is left in as a result of this transaction. Assume Exxon sells 1 million barrels annually and has no other debt than the crude-linked 5-year bond. We compare below the annual revenues and interest expenses of the company for different oil price scenarios, assuming in each case that the price listed applies to all sales of the company during the year. When prices are low, the company has saved itself some $3.68 million of interest expenses versus what it would pay on a straight 5-year bond, improving its margin and bottom line when every dollar helps, so to speak. When prices are high, interest expenses rise, eventually exceeding $5 million per annum and bringing the effective interest rate above the rate on straight debt. But under these same circumstances, revenues are skyrocketing and the company's margin and bottom line are rising anyhow, although by a lesser amount than they would have done if the company had issued straight debt. We see clearly in the table above that the company is effectively sharing incremental revenues 20/80 with its bondholders. For each additional $10 million in revenues achieved from rising prices for crude, the company pays out $2 million in the form of additional interest and retains $8 million. This 20/80 ratio reflects nothing more than the ratio of the barrels underlying the calls expiring in 1 year, 2 times 100,000, relative to a total annual production figure of 1 million barrels. In other words, the company forgoes the upside from 200,000 barrels and retains it on 800,000 barrels. The company is still doing very well in these circumstances, although perhaps not as well as competitors who have issued straight debt and are retaining 100% of upside. Inventory monetization is next on our list. This does not represent a large category of transactions in the commodities market, but in appropriate cases it reduces funding costs and improves leverage ratios for the company. We suppose now that Exxon has 1 million barrels of crude oil that it keeps in its storage tanks and wishes to borrow against them for 1 year on a non-recourse collateralized basis. By non-recourse, we mean that the repayment of the loan and the payment of interest can come only from proceeds of sales from this inventory. If prices decline and proceeds are insufficient to make payment in full of either interest or principal, the lender may not pursue Exxon for the shortfall. The company could request a loan and pledge the barrels as collateral, but the substantial price risk of crude would reduce the size of the loan a prudent lender would be willing to grant, or would increase substantially the interest rate on the loan, especially given the non-recourse nature of the proposed arrangement. If we continue to assume that annual vol for crude is 20% as before, then a 2 sigma decline in prices would bring the price per barrel down to $60, an event that has a 2.3% probability under normal distribution assumptions. This would make the lender reluctant to lend much above $60 million against inventory worth $100 million today, and this is even before the interest cost is included. Undoubtedly, a price hedge of some sort would reduce or eliminate this part of the lender's concerns and would increase the size of the loan and reduce the interest rate it carries. We suppose, for example, that 1 year forward prices for crude are 105 reflecting a contango pattern discussed in Chapter 1. Admittedly rare, but not unseen in the crude oil market. Inventory monetization works similarly to the securitization of credit cards or mortgages, with an SPV used to hold the assets backing the financing and appropriate measures adopted to avoid consolidating the SPV and its debt into the sponsor's balance sheet. So step 1 of the transaction involves the establishment by the sponsor, Exxon in this case, of a special purpose vehicle which will serve 4 principal functions. 1. It will purchase the inventory on day 1 from Exxon at the current spot price of $100 per barrel, i.e. for an aggregate of $100 million. 2. It will sell the crude oil under a 1-year forward contract to a highly rated bank for $105 per barrel, as mentioned previously. 3. The SPV will borrow from this bank for 1 year, or from another bank that is prepared to assume the counterparty credit risk of the first bank, an amount close to $100 million, which is still less than $105 million when we include interest for 1 year, provided the interest rate is below 5%. If we continue to assume that the risk-free rate is 4% as before, the spread under the loan should be well below 100 basis points, since, as we will show, the lender has minimal risk under this arrangement. Lastly, the SPV will deliver the crude oil in 1 year under the forward contract, receive $105 million, and use this money to repay the loan and all accrued interest. A rational lender should reasonably understand that its risks under the loan are essentially limited to the risk of default of the counterparty under the forward contract and the risk of damage or theft to the inventory prior to its delivery date. The first risk, furthermore, arises only if the price of crude is below $105 per barrel on the delivery date. If it is higher, the SPV sells the crude on the spot market on the delivery date rather than under the forward, and achieves higher proceeds than under the forward, so can comfortably repay all amounts due under the loan. In any event, this counterparty risk was deemed acceptable to the lender at the time the transaction was initiated and presumably was factored into the pricing. The risk of damage to the inventory, or its theft, is usually addressed with normal arrangements for property insurance, or it can simply be guaranteed by Exxon itself, since the crude is stored anyway in Exxon's tanks, so should not raise significant concerns with regard to damage or theft. Whether or not the transaction achieves improved pricing for Exxon from an interest cost perspective, it can usually be structured to attain off-balance sheet treatment under U.S. and international accounting standards. Exxon has not engaged in any borrowing of any kind under this transaction. Instead, it has sold crude and received cash in return, all at market prices, so entirely consistent with true sale principles of accounting. Exxon, in effect, has no further connection to the transaction after that point. The accounting treatment of the transaction should therefore be simply to debit cash and credit inventory, or in layman's language, increase cash and reduce inventory, in each case by $100 million. No debt is created via this mechanism on Exxon's balance sheet. It is the SPV that has borrowed money, the SPV that has signed the loan agreement and the promissory note, the SPV that is responsible for payment of the loan principal and interest at maturity, and the SPV that has hedged the price risk of the crude by entering into the forward. The company's leverage has remained unchanged, but the company has obtained funding to the tune of $100 million from a cash flow perspective, just as if it had borrowed money directly. What Exxon has given up is access to the inventory, since it is no longer the owner of the crude. This is often addressed by having Exxon enter into an oil borrowing facility with the SPV, permitting Exxon to borrow crude held in the storage tanks for periods that cannot exceed 1 year, subject to an obligation to return identical quantities of comparable grade, a grade that satisfies the specifications under the forward contract, before the settlement date under the forward. For this, the company would normally be expected to pay a borrowing fee of some kind, but provided this fee is not substantial, the benefits of off-balance sheet treatment for the company should be worth this extra fee. Our third and final application of commodity derivatives to the corporate fundraising process involves what is called a prepaid forward sale. This is similar in many ways to, but different in important other ways from, the inventory monetization example. We assume this time that Exxon is seeking 5-year funding that amortizes in equal annual payments, which include principal and interest, exactly like a fixed-rate automobile or mortgage loan. We assume here that all forward prices for crude are 105, so the forward curve is completely flat on this occasion. This time, Exxon enters into a contract with the SPV to deliver 1 million barrels of crude annually for the next 5 years, in return for an upfront payment by the SPV equal to the present value of the hedged proceeds from the sale of this crude by the SPV under a series of forward contracts. The SPV therefore enters into 5 forward sale contracts on 1 million barrels each, with settlement dates on each anniversary of the closing date for the transaction. Assuming again that counterparty risk under the forward contracts is modest, the SPV essentially has converted the future deliveries of crude from Exxon into a 5-year annuity of $105 million annually, so can discount these future cash flows in the market to raise an amount in cash equal to their aggregate present value. We assume a 5% discount rate is deemed sufficient by the bank discounting these cash flows, given the risk-free rate of 4%. The present value of this annuity is calculated on this worksheet proceeds, using quite simply the Excel operator PV. We set the discount rate in cell F7 at 5%, the number of individual payments under the annuity in cell F6 to 5, and the size of each payment under this annuity in cell F5 to 105 million. We program in cell F8 the operator PV from Excel and find this PV comes to 454.6 million. Note in the formula that we have set the future value under the annuity, the last item, to 0, since no other cash flows will be received by the SPV except under the 5 forward contracts. This $454.6 million is the amount the SPV can pay upfront to Exxon in exchange for Exxon's commitment to deliver 1 million barrels of crude to it annually. The lending bank, or more precisely the bank that discounts the SPV's future revenues under the forward contracts, is assuming this time a greater risk than under the inventory monetization. Specifically, the risk that Exxon fails to produce and deliver the 1 million barrels on any delivery date. This is not an unreasonable risk to assume for an oil major like Exxon, but of course it may be significant with smaller companies, and in any event needs to be factored into the pricing. The accounting treatment of the transaction is also different from that for the monetization. This transaction is definitely on balance sheet for Exxon, although it again does not increase the company's total debt. Specifically, cash is again debited on day one, this time in the amount of 454.6 million. But since no existing inventory is being sold that can be removed from the balance sheet, we need to offset the cash entry on the left side of the balance sheet with some other entry on the right-hand side. This entry represents Exxon's obligation to deliver crude in the future, for which no further payment will be received, since the payment was front-ended at the inception of the transaction. The situation is the same as that of a magazine publisher who receives upfront payment for an annual magazine subscription, or that of any provider of goods or services who charges upfront for goods or services delivered in the future. Accounting requires this obligation to be recognized in the company's liabilities under an entry normally called deferred income, deferred revenue, or something equivalent. The initial entry is for the full 454.6 million, but as crude is delivered in the future and the remaining obligation diminishes, a corresponding reduction in the size of this entry takes place. As we said, this is undoubtedly a liability, but probably not one that counts as a debt, strictly speaking. This can have important implications. If Exxon's loan agreements, for example, limit the company's total debt as opposed to its total liabilities, the covenant presumably is not affected by this transaction. This concludes this chapter 3.